Right, cool. This is it. Now let's take a winning trade. So essentially, you see price coming down on ES and on Nasdaq. So yeah, we're pretty correlated. We're coming down. Obviously, this is not the price action you want to be trading, but just for this example, we'll go with it. So essentially, at the moment, we're just basically watching the charts. We're waiting for our setup. So our setup starts with when we see a fair value gap. So essentially, oh, okay, here we go. We have got three candles where the first and the third don't touch, connect, or overlap. So essentially, you can see on this gap here, you've got one on this one here, one, two, three. So these three here, okay. We basically look at the first and the third, forget about the middle, we draw a horizontal line, boom, hits the third candle. There's no gap there. Whereas if we go on this one, we look at one, two, three, okay. We go look at the first one, we draw a line, oh, we don't hit the top candle. We draw a line here, oh, we don't hit that candle. So now we have got a fair value gap. And how do we know what colour it is? Because whatever the middle candle is, that colour, that's what the gap is. So the middle candle is green, the gap is there, and it is green. Cool. So at the moment, obviously, imagine if we had a liquidity sweep. Essentially, you could potentially say this was a liquidity sweep. There's a high here. We've come back down, and essentially, we've come up and we've swept the internal liquidity. We normally look for liquidity sweeps on a higher scale, like quite high up and quite low down, but sometimes you can look at them in a smaller range. So essentially, yeah, you could call that a liquidity sweep. And at the moment in time, obviously this is just to show the context of a winning trade, but as you can see, we haven't got an SMT at the moment. Because if I draw a line to the left, you can see on ES we've took this high, that's where that line is. Obviously the next higher candle is up here. We haven't took that high. On here we haven't took that high. So you can kind of see there's no SMT on the top, which essentially means there's no bearish SMT. And obviously, when you're bearish, you think price is going to go down. So yeah, there's no bearish SMT at the moment. So, but just for the trade, let's just say, imagine that is a bearish SMT, meaning we are looking for short positions. So essentially, what we now do is we have to wait for a candle close to fill in the bullish fair value gap. Boom! Wow, big candle, stuff you fair value gap, you've been filled in. So now we look to enter. So imagine we had an SMT, we've got an internal liquidity sweep. Okay, right, we would be looking to enter, but how do we determine our risk management? And like we said, risk management is everything. So already you can do this on TradingView. It will give you a risk to reward of 1-to-1 straight away. But remember, our stop loss, because we're in a short, you can make money when price goes down. So meaning our stop loss has to be higher up. And where do we do it? We see the top of this fair value gap here. It wouldn't be in line with the fair value gap because we want to have a candle close below. Like with this, we enter a bit after because we wait for a close below the fair value gap. So sorry, we'd look for a candle close back above the gap, and that's where our stop loss would be. So you, like I said, you normally give it a little bit of leeway. You could do like a 25 point stop loss as seen by 25 points. Ignore what 25 points is. It's 25 points, it says it is. So that's where we'd enter here, right on this candle. We'll give ourselves a little bit of leeway, and you can see the risk to reward ratio. So realistically, if I want to look for a 1-to-1, as soon as it hits one, bang on. As soon as price comes down here, we would look to sell. So normally you'll be looking for like places in the market of where you'd want to sell. So realistically, the next, I guess, valid point to sell would be at this low. So at least once we get to this in the market, we've got a 1-to-1. Anything after is just lovely. So we can aim for a 1-to-2 if we like, but realistically, like I said, a minimum 1-to-1. So you have an idea that you don't really want to sell before that kind of point in the market. So essentially, we've entered, we've gone into a short position, price comes down, absolutely smashes our take profit, and that's what I mean. If you held, you could have got a 1-to-2 like there, which would have been lovely. If you're risking 1% on a 50k account, you've just earned $1,000. If not, if you want to be nice and play it safe, you just got a nice little 1-to-1 and you've just earned your $500, and you can go away happy as Larry.